On this Thursday morning, the 30th of July, 2026, Bitcoin exchange-traded funds are staring at a sobering milestone. Data confirms that this month is on pace to register the smallest monthly inflows in the entire history of Bitcoin ETFs. That is not a slight dip. It is the worst ever. The numbers are so low that even the 2-month outflow streak we finally snapped in July barely registers as a victory. Inflows are technically positive, but they are a rounding error compared to the billions that poured in during previous months. Think about that for a moment. Investors are allocating almost no new capital into the most accessible Bitcoin vehicle on the planet, right as the price rallies. For anyone who lived through the ETF launch euphoria of 2024, this is a dramatic reversal. We need to ask whether the market is quietly sounding an alarm that the headline price just is not reflecting. To grasp the severity, we have to rewind a few weeks. Through May and June of 2026, Bitcoin ETFs hemorrhaged money. We recorded over $1 billion in net outflows across those 2 months. That staggering figure coincided with a 9-month low in Bitcoin volatility, as reported by TradingView data back in late May. Markets were frozen, capital was fleeing, and conviction evaporated. Then July arrived. The streak of outflows technically ended, and Bitcoin managed a 9% gain for the month so far. Yet the inflows that replaced those outflows are so anemic that CoinDesk, Yahoo Finance, and StockTwits are all running headlines today about the smallest monthly inflows ever. It feels less like a recovery and more like the market simply stopped bleeding, but without any fresh transfusion. That is not a foundation for a sustained bull run. Here lies the most uncomfortable fact for bulls. While Bitcoin has tacked on roughly 9% this month, on-chain data is screaming weak conviction. Being Crypto pointed out this morning that metrics like active addresses, transaction counts, and volumes are trailing far behind price. Historically, healthy rallies are accompanied by a surge in network usage, more unique wallets moving coins, and growing transaction demand. Right now, those signals are absent. The rally is happening on thin participation. This divergence is not something to dismiss. Similar patterns appeared before past corrections, where price pushed higher but the underlying blockchain showed fewer people actually using or transferring Bitcoin. The market is being lifted by something other than organic demand, perhaps derivatives positioning or a temporary squeeze, and that kind of price action tends to be fragile. Cast your mind back to late May 2026, when Bitcoin volatility sank to a 9-month low. At that time, $1 billion in ETF outflows had already been recorded, and trading volumes dried up. We are now sitting only 2 months past that point, and volatility, while slightly elevated, remains subdued. Historically, periods of extremely low volatility in Bitcoin are followed by explosive moves. The direction, however, is not preordained. With ETF inflows at rock bottom and on-chain activity muted, a violent downward move cannot be ruled out. The market is coiling. The question is whether the snap will catch the over-leveraged bulls off guard. When liquidity is thin and conviction absent, even moderate selling pressure can cascade. Today's inflow data suggests that the big institutional hands are not stepping in to provide a floor. If ETFs are not attracting capital, who is driving this 9% July gain? The evidence points toward retail traders and derivative markets, not the steady, long-only institutional flows that many hoped would define the ETF era. StockTwits retail buzz, for instance, is lively, and Rocket Lab's third Japanese satellite deal is getting more chatter than Bitcoin's infrastructure warning signs. That is telling. The Motley Fool published a piece on the 3rd of July arguing not to worry about Bitcoin despite the worst month ever for ETFs, reflecting the retail optimism that often emerges at the wrong moments. Meanwhile, the 10 best performing ETFs over the last 10 years list from YCharts in June reminded us that Bitcoin is a long-term story, but right now, short-term demand from the very vehicles designed to broaden access has virtually stalled. The buyers today are not the same as the buyers who pushed Bitcoin to all-time highs. Institutional behavior can be read through ETF flows, and the message is unambiguous. Large allocators, family offices, And pension funds that started nibbling in 2024 and 2025 have either stopped buying or are quietly trimming. The smallest monthly inflows ever do not happen if institutions are accumulating with conviction. Even with a 9% price tailwind, they are not chasing. Some may be deterred by regulatory uncertainties, others by the macro environment, and many simply because the risk-reward setup does not look attractive when on-chain demand is absent. The $1 billion of outflows we saw over 2 months might not have reversed, it merely paused. For UK investors watching from London today, this is a critical signal. Institutional money tends to lead, not follow. If they are not buying, the current price level may not hold. What happens next depends on whether anything can reignite spot demand for Bitcoin ETFs. A catalyst could be a sudden regulatory approval in a major market, a central bank pivot, or a technological upgrade that sparks genuine usage. Without that, the path of least resistance may be downward as July closes and August historically brings thinner liquidity. The fact that we are discussing the smallest monthly inflows ever on the final day of the month suggests that August could easily tip back into net outflows, especially if the 9% July gain tempts short-term profit takers. On-chain weakness is a ticking clock. If active addresses and transaction volumes do not pick up within the next 2 weeks, the conviction gap will become impossible to ignore. Each day without a meaningful inflow print reinforces the bearish divergence. The market is not yet in crisis mode, but it is on the precipice. If you take one thing away from today's data, let it be this. The price of Bitcoin, currently showing a 9% monthly gain, is a shiny object distracting from the real story. Record low ETF inflows, recovering from a $1 billion outflow streak, on-chain metrics at low conviction levels, and persistent low volatility all point to a market that is not healthy. The rally is built on thin air. Wise investors will watch the inflow figures over the next few days, monitor active addresses, and ask whether genuine demand is returning. Do not be seduced by a green number on the screen. The worst monthly inflows ever is not a phrase that belongs in a strong bull market. Stay cautious, stay informed, and remember that in crypto, what you do not see is often more important than what you do. Subscribe to keep seeing the full picture.